just get out there and start clicking buttons. One of the things that people do is they confuse a good investment with a good company. So if somebody tells me they're a fundamental investor, right? So I'm talking about the wealth bucket now. I'm talking about your retirement account. So if somebody tells me they're a fundamental investor, the fundamentals of a company, that's the balance sheet of the company. So that's when somebody's looking at how much money the company makes. And what they're trying to do based on how much money the company makes is determine what the price of the stock should be per share. So have you guys ever heard of a price-earnings ratio? Right? Or some people take a price-earnings ratio and divide it by growth. They call it a PEG ratio. There's literally millions of different ratios to use. We're not going to teach you any of that accounting stuff at the academy because 9 times out of 10, I mean, there's lots of reasons not to use that stuff all by themselves in isolation. The biggest reason not to use them is, would it be fair to say that sometimes companies don't always report accurate numbers? Has that ever happened? Yeah. Are they using GAAP accounting methods or non-GAAP accounting methods? What's the interest rate that they're using or the tax rate that they're using? So companies can cook the books, can fudge the numbers, and it happens all the time. It happens a lot more than you think. In the 90s, there was a company called Waste Management. This was a company that investors loved because every single quarter, this thing just continued to climb, right? It was a moonshot because the money they were making was just unreal. Every quarter, they just had blockbuster earnings. Well, somebody finally took a closer look and realized they'd been cooking the books the whole time. They had about 1.7 billion, that's billion with a B, in fake earnings on the books. Now, you tell me, what do you think the price of the stock did when the marketplace found out the whole reason it was up was phony? Bang. Impossible to get out of. Now, if this is in your wealth bucket, you've got a real problem on your hands, getting out of that trade when everybody else wants out too, right? Enron did the same thing a couple of years later. Then it was WorldCom's turn, and another company called Tyco shortly after that. Then it was a company called Health South. Even Freddie Mac. Freddie Mac's a government entity. They cooked the books to the tune of $5 billion, right? $5 billion. Then it was AIG's turn, then it was Lehman Brothers' turn. So my point here is, it's like the cockroach theory, right? You flip on the lights in the middle of the night, you see a cockroach, chances are there's 100 of them you don't see. So just be very careful of using fundamentals all by themselves. Another thing is using a financial advisor to manage money, right? A financial advisor is typically a 100% commission job, right? They get paid a fee of your assets every single year. Year after year after year after year. And it's the fees that actually, as they start to stack up, that's what absolutely kills your long-term rate of return. If the market's going up, your financial advisor is going to get paid a fee, right? And again, that's usually about 2%. So I'm talking about the guys at Wells Fargo Asset Management or JP Morgan Private Client. You know, they're all wearing really nice suits, and you go in, the office smells like leather, right? And it just kind of feels like money in there. That's a commission job. Right? And typically they're charging 2%. 1% goes to that individual advisor. Right? That's his fee. That's why when you call them up to close your account, they hit the panic button and do anything they can to keep you on board there because you're his bread and butter. But 1% goes to him, the other 1% goes to the house, the brokerage firm they work for. Does a financial advisor also get paid if your account doesn't grow 1 year? So they're in charge of managing your money, and if it doesn't grow 1 year, do they still get paid?
Yep.
Okay, and how about if the market goes down? Do they still get paid if the market goes down? Yeah, so they make money no matter what. Now, if I told you that if the market's going sideways, right, well, the rate of inflation is 2%. The fee they're charging is 2%. So that's a down year. Not to mention the dollar might be changing and your buying power is less. If the market's going down, well, then, yeah, obviously what you own is shrinking in value, and then they're going to kick you while you're down. They're tacking on another 2% on top of that. It's only when things go up in value that you stand a chance to make money. But how much does it have to go up before you see a profit? Well, again, the rate of inflation right now, as of today, is about 2%, so it's got to clear that hurdle. The fees that you're paying to the advisor, well, that's another 2%. So 2 and 2, that means it's got to go up more than 4% before you make any money. That leaves you on a good year with that little sliver right there. So using a financial advisor, the deck is literally stacked against you. Now, if I told you I got a great investment idea for you, it's a good one. So I think you really ought to put everything you have into it. So at the end of the night tonight, go home, sell everything you have. Your house, your car, cash out of your 401k, your IRA, any artwork you have, just sell it all. Bring every penny you have back here to me. And this investment idea I have, you'll have a 1 in 3 chance of making money with your life savings. How many people would do that? You'd be crazy to. You'd have better odds going to Vegas and putting everything on black, right? Then at least you're close to 50-50. But that's what people do when they lock themselves into a fee arrangement. They literally stack the deck against themselves. It's almost impossible to come out ahead, right? So just be very careful with using a financial advisor. If you have a financial advisor and you're paying somebody 2% to manage your money, and all they do for you is put you into different mutual funds, and those mutual funds charge you 2% a year, they're basically getting a double dip on you, right? They're not doing you any favors. So just be careful. Now, also not understanding retirement plans. Does anyone have a 401k? A few of you? Okay, great. If you have a 401k, jot down on your notepad which mutual fund you own the most of in that thing. 401ks are a combination of mutual funds. They give you some choices. And you know about 95% of the people that I meet can't tell me which mutual fund they own the most of. All right. Well, I set it up a long time ago. You know, I know it's got something to do with value or growth or sounded good when I set it up, right? Just not sure exactly where it is. But look, that's your wealth bucket. That's the money you absolutely, positively has to be there for you. And you should know where that is. And if you can name the fund, every once in a while someone will say, well, I'm in the Fidelity. It's the high fee, low return fund. Then they can't tell me which investments are in that fund. And I think you'd be surprised to learn about 86% of mutual funds do not beat the underlying S&P 500. Think about that for a second. 86% of mutual funds do not keep up with the basic stock index. And you're paying a fee for somebody to assemble those stocks for you, and they can't even not only outperform, they can't even keep up with the indexes. But most mutual funds, they own the same stuff. If you look at the top 10 holdings, Microsoft, Apple, Facebook, Google, they all own the same stuff, right? Also, are you concerned about the price that you pay? In your 401k, do you allocate resources to that mutual fund because the price is advantageous to you? Or do you allocate resources to that mutual fund just simply because it's payday? So if you're buying with no regard to price, when is it you decide to sell? After things have gone up and appreciated? Or most people never have a plan to exit until they retire and need the money. And if that's the case, then you're literally strapped into your retirement account. You're just in the, right, you got the seatbelt down and the helmet on and the chin strap, and you're basically just kind of going for a ride. And then what you're doing at that point is you're just hoping, right, that when you retire, the market happens to be up here instead of down here. But you don't necessarily have control over that, right? Also, what are your choices in a down market? That's probably one of the biggest reasons people come through the academy to learn how to what we call self-direct, right? Where they take control of the 401k or the IRA. They don't pay fees to somebody else. They basically build their own mutual fund, right? But they want choices in a down market because things go up and things go down, right? And then also, what's your probability of success? And do you really fully understand all the fees? Again, the fees kill you. There's what's called a 401k fee in every 401k. There's also a thing called a REC fee. If you own mutual funds in your 401k, you also pay fees to those mutual funds. So if you ever add those fees up, it's absolutely devastating. Actually, ABC did a great report not long ago about 401k fees. They said the average couple in the U.S. over the life of their 401k will pay about 30% of the balance in just fees. Now think about that for a second. That means the average couple, husband and wife in the U.S., will pay about $155,000 in fees over the life of their 401k. Right? Now, the average person in the U.S. makes $50 grand a year. If you're making $50 grand a year and you're going to pay $150 in fees, that means you're working 3 years out of your life to do nothing but pay fees. So again, I'd rather see you learn how to do this yourself, right? Self-direct, build your own mutual fund, and keep this money in your account, right? Also, Social Security, we talked about that. We used $1,500, right? $1,500 a month for 12 months was $18,000 a year. The average in the U.S. is actually $1,335 per month. The good news is in 2017 they gave us a cost of living increase of $267. So I'm not sure exactly what they thought we were going to do with an extra $267, but apparently that was going to put our lifestyle over the top. Unfortunately, Medicare is going up this year from $122 to $150. So what retirees are realizing this year is they're actually bringing home less money this year, right, than they did in 2016. And that's a trend that you should expect to continue, right? As I said earlier, the Social Security system, now they take long-term disability payments out of the Social Security fund, and there's more people on long-term disability now than ever before, right? It's completely killed that fund. But you know when they take Social Security out of your paycheck, you know that doesn't go into an account with your name on it. And then when you retire, that's the money that you get, right? So who do they pay with the money that's coming out of your check right now? The people that are retired, right? Now, anyplace else, that's called a Ponzi scheme, right? So what's going to happen if the number of people that are working actually starts to shrink like it is now? And the labor force participation rate's the lowest it's been in 25 years. And what's going to happen when all the baby boomers start to retire? So the number of people that are working is getting smaller, and the number of people that are retired is getting bigger. And those people that are retired are living longer and longer and longer. That system's broken. Mathematically, it's impossible for it to come back, right? You know, in 1955, the average life expectancy in the U.S. was 68 years old. They only paid your Social Security for 3 years, right? Well, now people are living longer and longer and longer. They never planned for that correctly, right? So, again, for the younger people in the room, when you're planning your wealth bucket, I would not plan on that being there in any significant way for you. Also, investing in mutual funds, right? And the fees you pay there, they can be hefty. Has anybody heard of Vanguard? Okay, Vanguard's a huge family of mutual funds. John Bogle was the founder of Vanguard. He's written several books about what Wall Street did to the mutual fund business because he's become really discouraged with what they did. They turned it into a fee generator for themselves. A great book he wrote is called The Common Sense of Mutual Funds. If you're a mutual fund investor, do yourself a favor, go to Amazon tonight, buy that book for $8. The Common Sense of Mutual Funds. B-O-G-L-E. At any rate, the whole idea behind long-term investing, the whole idea behind that is that concept of compounding interest, right? Einstein used to say compounding interest was the 8th wonder of the world. Like, the sooner you get started, the longer you leave it in, you don't touch it, you just let it grow, and the bigger that it's going to get, right? So let's say tonight, right now, you whip out your checkbook, and you just write a check right this second for $10,000. You put that $10,000 into an account for 50 years and you never look at it. And it grows every year for 50 years at just a 10% rate of return. 10,000 after 50 years at 10%. Does anybody know what that turns into? It's about $1.2 million. That's the power of compounding, right? That's the whole idea behind long-term investing. But look, his point is, if somebody's taking a 2% fee off the top, that completely changes the whole equation. That 2% fee, like a mutual fund fee, comes right off the top every year. Then that money that's coming off the top doesn't participate in the compounding effect. And after 50 years, it hurts that number to the tune of about $700,000. That means if I have two people, both contributing $10,000 one time, both leaving it in the account for 50 years and not touching it, and both making a 10% rate of return. But this person does it themselves. They don't pay a fee to somebody else. They have 1.2 in their account. But if this person makes 10%, pays a 2% fee, so essentially they make an 8% rate of return, after the same 50 years, they've got less than 500 in their account. Now again, I'd rather see you learn how to eliminate the fees and see you be here than down here. After all, in this example, who takes 100% of the risk, us or Wall Street? It's our money. If things go south, it's all on us. But after 50 years, who comes out ahead collecting fees? Right? So again, learn how to do it yourself. Now also, not having a plan for a down market. This is do you guys know what the S&P 500 is? Yeah? Okay. So this stands for Standard & Poor's 500. It's an index of 500 stocks. So the Dow Jones 30 is only 30 stocks. So out of 4,500 stocks out there, to only look at 30 of them and judge what's going on, it's kind of a narrow gauge, right? So what a lot of people like to look at more than the Dow Jones is this S&P, because it's 500 stocks. So instead of Dow Jones, it's Standard & Poor's. Instead of 30, it's 500. This is a candlestick chart from 1980 to the year 2000. You'll see over that period of time, the market was up 1,400%. Now, if something's up 1,400%, you don't necessarily need to be an all-star stock picker, right? You certainly don't need to be in and out of the market, right? Literally, this is the period of time where people started to say buy and hold was an investment strategy. You guys know before 1980, nobody ever told you the way to make money in the stock market was to buy and hold. It was always buy low and what? Sell high. That's how you make money in the stock market. But look, after something's up 1,400%, well then yeah, in hindsight, all you got to do is buy and hang on for 20 years, right? But This period of time back here, this is where companies realized it was too expensive to pay employees a pension for the rest of their life, and they started to allow employees to put money into a tax-deferred savings plan. This thing was just created called a 401k. 401k was never created to be a retirement plan, but Wall Street turned it into retirement plans because they can charge fees on it. So when all that retirement money, right, coming out of the paychecks of employees, trillions of dollars of retirement money, started to go into the stock market through 401ks, right? 401ks own mutual funds. Mutual funds own stocks. That basically levitated the stock market, and we had pretty much this straight line trajectory, up, 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 where kind of all boats rise with the tide. Then you'll notice right over here in 1995, the chart kind of does that hockey stick thing at the end. It basically points straight up. Does anybody know what was going on there? That was the dot-com bubble. That's when internet stocks took off and things just blasted straight up, right? Now that's when buy and hold worked. This is what the market looks like now. So does buy and hold work over the past 20 years the way it did previously? Well, where the last chart left off to where we are now, the market's up about 52%. Well, look, if you're paying a 3% fee for 17 years, that eats up your entire rate of return. And we've had two major corrections here over that period of time, one to the tune about 50% and one about 56%. Right? So learning how to make money when things go down in value, or at the very least, learn how to protect what you have. Right? The idea is you don't want to learn how to protect what you have down here. Learn how to protect what you have when the market's up here, right? Or when the market's up here, or when the market's up here. That's the time to learn how to protect what you have, right? And learn how to insure what you have. And now, since the lows in 09, we're up over 240, almost 250 something percent. So we haven't had a run like that in that short amount of time since the dot-com bubble, right? And that did not end well for people. Right, so trees don't grow to heaven, markets don't go forever. You know why they don't call this thing a bubble yet? I mean, if this was the dot-com bubble, and this was the real estate bubble, how come they don't call this a bubble yet? It hadn't popped. But after it pops, they'll call it a bubble. Right? They'll call it the quantitative easing bubble, or the zero interest rate bubble. So I had a lady, you guys ever seen them show The Golden Girls? You know that show? So I had a lady in one of my classes. Remember the mom on that show? The little white-haired lady? So I had a gal in one of my classes who was sitting right in the front row. She looked exactly like that lady. And she was the first one there that day, right? And she got there early, sat in the front row, was taking notes, you know, basically writing down almost every single word I said. And at some point I started making fun of financial advisors. Not making fun of them, but just kind of giving them a hard time because it's a commission job, right? Anyways, I started giving them a hard time. And she raised her hand real quick and said, well, I just have to tell you that my husband and I are 100% satisfied with our financial advisor. So I'm thinking to myself, oh shit, I bet her financial advisor is her son or daughter or somebody she's related to, right? And there I am making fun of them. So I started to backpedal a little bit. I said, well, you know, they're not all bad. Some of them are really well-intentioned, you know. I said, nobody cares more about your money than you do, obviously. I said, how long have you been with? And she said, well, my husband fired our old financial advisor, and we rolled all our money over to our new one in 2009. So I'm thinking to myself, okay, well, I see what happened there. Somebody kept them in the market, and they probably lost 50% of their life savings. They got pissed off, they fired that guy, and rolled all their money over to the new advisor someplace down in here, right? So he got them as a new client somewhere near the market lows. So he's obviously got to be looking good. So I said, well, how's he been doing for you? And she said, well, as I said, we couldn't be more satisfied. She said, every year, just like clockwork, we get about an 8% rate of return. And I'm thinking, man, talk about perspective, right? 8% and paying a 2% fee to do it. So here she is making 8% and paying somebody to do it for her. Meanwhile, the market's up over 240%. That means since the lows in 09, your retirement account, right, your wealth bucket should have doubled, and then it should have doubled again, and then some. And here she is only making 8%, paying somebody to do it, had no idea, right? Completely changed her perspective. So now we're all the way over here. Things have never been better. We're at the absolute all-time record high. So is your wealth bucket where you need it to be? Could you retire right now if you wanted to? And some of you could probably say, well, yeah, you know, if I had to right now, I could probably pull it off. Well, if we have a 50% correction from here, which is just the average, right, and this thing gets cut in half, could you still retire? And if you haven't met your goals yet, if you're not where you need it to be, and the market's never been better, if we do have a correction from here, well, then you're going to be then it's going to be set you back. You're going to be farther away from your goals and where you are now. So again, to learn how to do this, we're in a perfect time market-wise. And you can make a lot of money when things are going down in value. This is actually the S&P before all the 401k money started to pour into the market and before the dot-com bubble. And what you'll notice here on this chart is about every 4 or 5 years, just like clockwork, we have a major market correction. The other thing you'll notice on here is the rate of decline is getting bigger and bigger and bigger. So the last one we had in 2000 was 49%, and then the last one we had in 08 was 56%. So when the next one rolls around, it's going to be a doozy, right? Also, not being properly diversified. For those of you that are more focused on the wealth side of things, what we do for our students is we actually publish 2 portfolios every month. We call this proactive investing. And this is in an effort to keep you diversified. So you could literally follow along with these every month if you wanted to. So this is not active trading. This is not zigging and zagging around every day. This is literally every 3 or 4 weeks. Make it just a small little tweak, a small little adjustment. And what changes on a fairly infrequent basis is the percentage allocation into the different asset class. And how this changes is based on market conditions. So these are different asset classes. I had a guy in one of my classes who was convinced he was diversified because he owned 5 different mutual funds. And we went round and round and round. He's like, no, I got my risk all spread out. I know what I'm doing. I know what I'm doing. And finally, I just kind of threw him the towel. I said, look, sir, I said, you own 5 different baskets of apples. When the apple market goes down in value, all 5 of your baskets are going down in value. You are not diversified. You're diversified in one asset class. You own lots of different stocks, but that's all one basket. You want to be diversified in different things because they move in different ways. So we call that proactive investing. In the 3-day program, we walk through 4 different strategies for people that are going to self-direct and not pay fees to somebody. Because that concept of buy and hold, remember, that's benefiting the person you're paying fees to. That's not necessarily benefiting you, right? So let's shift gears a little bit, and let's talk about short-term income. In terms of doing this either part-time or maybe for a full-time job, maybe you don't like what you're doing, maybe you're working a couple of different jobs, and you'd rather be at home and trade instead of being away from the family for the second job or whatever it is. Or maybe you're just, not making the money that you want no matter how hard you work. So you want to be in something that gives you a little bit more upside potential, or maybe you're in a business that's downsizing, or technology is going to put you out of business, or maybe you're just thinking, man, at this rate, I'm never going to be able to retire. So again, in terms of learning how to do this the right way, and I'm talking about generate short-term income, being an active trader, here's a list of 8 or 9 things. We found these are the common mistakes that people make when they try to generate income for themselves, and they really don't have any formal education in terms of how to do it. Number 1, the biggest thing is not understanding leveraged assets. So people think they have to trade stocks. And stocks are open a limited amount of time a day. They're expensive to trade, and they don't offer you great leverage. They're not a great tool to use. If the only tool in your toolbox is a hammer, everything looks like a nail, right? They're just not a good tool to use if you're focused on income. If you were trying to make, say, an extra $50,000 a year, right, if this was your goal, and you had a $500,000 trading account, well, a 10% rate of return in the stock market, right, that would put you on $500,000, that would put you right at 50. But look, instead of tying up all that capital, why not open up a $5,000 futures account or maybe even a Forex account and start to control a lot of something for a little bit of money, right? It's a much more efficient way to go about your business. So one of the most popular things to trade is a thing called the E-mini, right? E for electronic and mini for miniature. If you know somebody that's an active trader or in the markets a lot, tell them you went to a workshop tonight and that the instructor was talking about E-minis. If they're involved in the markets, they'll know exactly what you mean. This is the most actively trading futures contract that there is. Now, when you go to your online broker, you want to buy or sell a share of IBM, or you want to pull up a chart of IBM, right? The symbol that you type in your online broker is IBM. When you want to make a trade in this thing, or you want to pull up a chart of this thing, the symbol that you type in is ES, and then one more letter for the month that it expires. So this ES is a futures contract. So it's not the symbol for a company. And it's not the price of oil or the price of gold or the price of wheat. What ES represents is actually the S&P 500. So it's a stock index futures contract. So on the nightly news, when the guy said, well, the S&P was up 4 today, that basket of 500 stocks is moving around all day long, and it ends the day up 4. Well, look, this futures contract that represents it is moving along with that thing, penny for penny throughout the entire day. Right? It's going right alongside it. It's doing exactly the same thing. It literally represents the same thing. Now, one of the reasons people love to trade this thing is because the difference between the lowest price it trades and the highest price it trades every day, on average, is about 20 points a day. Right? The difference between the lowest and the highest, right? The range on the day is usually about 20 points. Not every day. Some days it's a whole lot bigger than 20. And if something big is going to happen tomorrow, like an economic report, well, then maybe today's range is a little smaller, right? People are waiting for that little piece of news. But on average, this thing moves around about 20 points a day from high to low. Now, let's just say, for example, you come through the 3-day program. Let's say you sit down with your coach and you tell him, I'm here because I'm primarily focused on learning how to generate income. I've got a full-time job, so I need to trade something that's open at night. Okay, futures or forex. So I don't have a lot of money to open an account, but I got $5 grand I can put together to start, but I don't want to pay a lot in commissions. Okay, futures or forex. And you guys start to go through the process of building out a trading plan and a risk management plan based on you and your account size and how much time you want to spend doing it and kind of what your personality is. You guys come up with this written plan, right? So you start to get after it, you start to actually trade this thing, and you decide, okay, the futures markets are the thing for me, and specifically I'm going to specialize in trading this thing. So for an hour a day or whatever it is, you're just going to drill down, you're going to focus on buying and selling this thing. Now, realistically, right, if you sat down and you started to buy and sell this thing, if you knew where those turning points were, right, where the banks were going to cause big moves one way or the other, realistically, out of a 20-point range, how many points of profit do you think you ought to be making on a daily basis? What would your expectations be going in? So there's not really a wrong answer. Just don't say 19. Right? Because nobody's going to buy the low and sell the high every single day. That's just not realistic. 10, you said? Okay. So who else has got a guess? 10 would put you right here in the middle. That's a good guess. This would be 15. This would be 5.
I was thinking 5.
Thinking 5. Okay, that puts you down here.
Depends on what you're making, how much you have in.
Mm-hmm. Well, if it's it moves around 20 points from low to high. So let's just say you're trading one contract, the smallest increment you can. What do you think? How much out of that range should you be able to make? So when I do an options class, I always err on the side of being really conservative. I like to under-promise and over-deliver, right? Have students' expectations, be really reasonable, and then just let people be pleasantly surprised, right? So let's just keep our expectations really realistic. Let's just say, I'll take the lowest one, let's just say we're going to focus on making 4 points a day. Does that sound realistic? So I'm not being Mr. and Mrs. Perfect, buying the low, selling the high. I'm not catching every single squiggle. I'm literally just focused on making 4 points a day. Now this might be 4 trades where you literally just got in, boom, boom, and you got out right away. And you made 1 point. But you did that 4 times in a row, so you were plus 4. Right? That would only cost you $1 to make a trade. So the cost of going in and out is nothing. So maybe, or maybe it's 2 trades. Maybe on one trade you actually made 8 points, but then on the next trade you actually gave 4 back where you lost 4. So you still ended at plus 4. Or maybe it's 2 trades. You made 2 points on each one. However you want to skin the cat. If you make 4 points, a point in this S&P contract is $50. Well, that means you had $200 in profit that day. Now, I forgot to tell you, this thing's open 6 days a week. How many days would you like to trade? All 6? Okay, I like the way you think. But let's just do 5. If I'm doing $200 a day, Monday through Friday, that puts me up at $1,000. Now, how many weeks out of the month do you want to do it? Well, let's just say 4. So that puts me at $4,000 for the month. And then how many months out of the year do you want to do? I had a guy tell me 10. You want a month off in the summer and a month off in the winter. That sounds good. But let's just do 12. What's 4,000 times 12?
40 years.
So $48,000? Well, look, that sounds like a much more efficient way to go about my business. So now I'm not telling everybody in the room, listen, you've never traded before, come through 3 days at the academy, and in your first year of trading, you're going to turn a $5,000 account into 50. It could happen, but that's not where your expectation should be, right? What if you just spent 6 months just getting comfortable? Literally spent the 6 months doing this, just getting comfortable with your broker's platform. And if you're not real computer savvy, after 6 months, all of a sudden, well, now you're not clicking on the wrong buttons anymore, right? You kind of know your way around a little bit. You're not buying it when you're trying to sell it or selling it when you need to buy it. I mean, after 6 months, you kind of got the hang of it a little bit, right? Would you guys think it'd be a little easier for you after 6 months of practice? My dad used to always say everything's easy when you know how. Right? Well, after you do this for a while, so let's just say you spend 6 months just kind of getting comfortable and learning your way around. And then the next 6 months of your first year, you just focus on making 4 points a day. And sure enough, after you do that for 6 months, you've got the statements in your hand, you start to go through them, and you realize, man, I'm making 4 points a day. And you say you're at the beginning of year 2. So at the beginning of year 2, you say to yourself, okay, well, listen, I'm not putting any more money in my account, and I don't need to do that. I'm not going to all of a sudden try to make 8 points a day, because I'm real good at making 4, so let's just stick with what we're good at, so I don't need to spend any more time doing it. But instead of trading 1 contract at a time, now you start to trade 2 contracts at a time, and just do the very same thing. What happens to this number when you go from 1 to 2 contracts? It doubles. You do that for a year, then you go from 2 contracts to 4 contracts. You do that for a year, then you go from 4 to 10. So it doesn't happen overnight, right? It's a process of skill set development. First you get the knowledge, then you develop your specific skill set, then you put risk capital after the ideas. But if you're focused on income, learn how to trade these asset classes where you actually have an advantage, right? Where you have just more bang for your buck. Now also listening to the media gets people in trouble. Anybody know who this is? Jim Cramer. So Cramer's got a call-in show, right? He likes to say booyah when it's time to buy a stock. And Jim Cramer comes on and says, booyah, let's all buy this stock. Right? What do you think the guys on the Goldman Sachs trading desk do when Jim Cramer says booyah? They sell it, because who's buying it? All the retail people that don't know any better, that are just doing what the expert says on TV. So just be really careful of who you listen to. What we used to always say is buy the rumor, sell the fact. Right? By the time you see it on TV or read about it in the newspaper and a magazine, and that thing's already priced in the market. Right? The market's way ahead. So also not understanding how to short. We talked about that too. Remember last year we had the Brexit, the British exit, right? Where the UK left the EU. And then that vote really roiled markets, right? They were not expecting that at all. The Dow Jones dropped 600 points in a day. This S&P was down 60 that morning. Look, if you know how to short this thing on just 1 contract, and it goes down 60 points for you at $50 a point, that's a home run. You just had a great month, literally, in 1 morning. So things drop a whole lot faster than they go up. Learn how to short the market. Also, using traditional technical analysis gets people in trouble. This is kind of the other side of the coin of fundamentals. Remember, the big picture people like to look at balance sheets, but companies lie. The short-term people like to use historic or traditional kind of technical analysis, the mathematical models that generate buy and sell signals. So literally, there's millions of these, what they call technical indicators. We're not going to teach you this stuff in the academy either, because quite frankly, I'm not going to waste your time doing that. That's how the market used to work. And you can buy a $25 textbook off eBay. It'll tell you every single thing you want to know about technical indicators. Or there's tons of free YouTube videos, right, that you can watch on how to use technical indicators. But these mathematical models, now I know you probably can't see it from where you're at, but there's red and green candles inside here. Those, the squiggly line on top, right, and the squiggly lines down below, those are technical indicators. So these things literally generate buy and sell signals for people, right? So they're usually named after the mathematician that created them. But realize these are lagging indicators because they're math. That means they don't update until something changes. So the inputs for these things are either volume or price, which means you never get a buy signal until volume occurs and the price moves up. Then you get a buy signal. And you don't get a sell signal until volume occurs and the price moves lower, which means you end up buying high and selling low. That's the exact opposite of what you should be doing. So if you're here and you're using technicals, that's why you're here tonight, because you're frustrated as all get out. You're trying to be disciplined, but this is flawed. This is the way the markets used to work before computer algorithms took over, right? Now what we want to teach you how to do is look at a price chart and determine where those areas of imbalance are. And if you know where the imbalance zones are, what the picture, what the pattern looks like, you can use these as a leading indicator. So we have what we call zone qualifiers, zone, Z-O-N-E. And these zone qualifiers, there are literally 12 of these things. What these turn into is a checklist that's 12 items long that you're going to go through step by step by step to identify 2 zones on a chart. We actually patented the process to do this. So we have a guy in Dallas who's a student of ours in our Dallas campus, and he's a chiropractor. And this guy's done a great job building his business throughout the years, right? He's got 4 or 5 offices all around the Metroplex. So during the day, during working hours, his primary focus, his priority is his business. So he's running all over the place managing his business. But he's an income trader. And so what his trading day looks like is he gets up about 45 minutes early. He pulls up a chart of whatever it is that he's trading that day. And again, he's an income guy, so it's futures or Forex. He pulls up the chart, he drops down, goes through the process, identifies 2 zones on his time frame of choice, right? Again, shorter term because he's income. And then he builds a trading plan around those zones. So if you know where these zones are ahead of time, you can build a trading plan around them and use these as a leading indicator. In other words, I want to buy down here where the banks are buyers, and I want to sell up here where the banks are sellers. I want to buy against a demand zone, and I want to sell against a supply zone. So he enters his orders ahead of time. We call that process set it and forget it. I'm going to show you how to do that tonight. You can set these trades up ahead of time. So if you want to be in front of the computer and actually click the button when it gets to your zone, you can do that if you want to, right? Or you can set these trades up, send all your orders in together as a package early in the morning before the market opens, do what you want to do with the rest of your day, and then just check and see how you did at night. So we call that set it and forget it. I'll show you how to do that tonight. But look, I know where I want to be a buyer and I know where I want to be a seller. Those orders can go in any time. Then you're just waiting for the market to come down to where you want to buy it. Bang, you're filled. And if the zone works, the coolest thing about this methodology, what I like about it, is that you know you're right or you know you're wrong right away. So as a trader, that's the best, right? It never comes down to the zone. You buy it and then it sits there and 1 minute you're up a nickel, down a nickel, up a dime, down a dime, and you don't know what to do, so you end up just getting out. The cool thing about these zones is when they work, and obviously they don't work every time, but when they work, it's literally like keeping a beach ball underwater. It pops right off the zone. And the bigger the imbalance here, the farther prices go. The bigger the imbalance here, the faster prices go. So it literally lifts right off the zone. So if you're trying to click the button when it gets there, you got to be quick. Better off to just set it up ahead of time, let it come to you, use the size of the zone to manage your risk, and then where the momentum takes it, right, where the pendulum is going to swing, is right up to the opposing zone. Now this is actually a real trade that we made in one of our live trade rooms. You could have been logged in from home watching the instructor trade his account live in the market. I mentioned all our instructors trade live real money account. This instructor is trading 10 futures contracts at a time. So please tell me nobody's going to come through 3 days with us and start trading 10 at a time, right? 1 at a time to get started with. But if you're trading 1 at a time and you're just following along with what the instructors are doing, right, just move the decimal point over about $600. Now, I should also tell you, it took about half a day to go from this level to this level. So it took about half a day, but that's about a $600 profit in half a day. Right? That's not a bad little income trade. Again, I'll show you how to do that. Now, also not being aware of market traps. So would you guys agree that the banks can sometimes paint the picture and trick novice traders into doing the wrong thing at the wrong time? You think that ever happens? Where they kind of throw that lure out there and lure people into making bad decisions? Right? So banks do that all the time. Right? The big boys on Wall Street, especially if you're a technical trader, if you're using technical indicators, Goldman Sachs read the same book you read. That means they know your playbook. Right? They know exactly what you're waiting for before you click the button based on that indicator that you're using. Right? So they can paint the picture. They can manipulate prices and make things happen on a technical basis and then run things the other way. Actually, 3 three big banks, Citicorp, JP Morgan, UBS, they pled guilty to felony charges for rigging the foreign currency markets. Right? So we actually caught them manipulating prices and taking advantage of retail people. Right? So the good news for you guys is we caught them doing that stuff to retail clients. We fined them $6 billion, so now they're not doing that anymore, right?
Gotcha.
If you could make $20 billion doing something, they only charge you 6, would you keep doing it? Yeah, it's a cost of doing business for these guys. So one of the things the instructor will do in the 3-day program is he's going to spend the better part of one morning just walking you through different market trap scenarios. The market traps are literally the landmines that people step on. That's how you blow up your account. You don't even realize it. Right? You got lured into doing the wrong thing at the wrong time. So once we show you what those landmines look like, once you can see them sitting there plain as day, not only will you not step on them, but when you can see them there, you can actually turn the tables and turn those into profitable opportunities for yourselves. So we'll show you what that looks like. And then also, not having a risk management plan. Right? Most novice people, they don't practice good risk management. Right? They take on a whole lot more risk than they realize. My dad used to always say, risk is only a bad thing when you don't know you're taking one. Right? Most people take on a whole lot more risk than they realize. They don't practice active risk management. They'll email me or call me up and say, hey, I just bought some shares of Amazon. What do you think? Like, okay, well, where are you getting that? Well, I don't know. Let's see what it does. That's not a plan, right? That's not a plan. So if you got with a professional trader from Goldman Sachs, right, a guy coming out of 40 Wall Street, and you just cornered him and said, hey, listen, you trade full-time for Goldman. Tell me, do you guys practice good risk management over there? What do you think they would say? It's going to say, man, there's 10,000 people that work in risk management. It's a whole floor of a building in Manhattan. Every single thing we do, it's all about risk management. If you got with that same trader and said, hey, listen, when you trade at Goldman, do you have a process that you follow? Do you have a rule-based strategy to make trades? Or do you kind of sit down in your seat every day, then depending on how you're feeling, that's kind of how you light them up? He's going to say, man, I couldn't trade a nickel of the company's money until I learned how to trade the Goldman way. Right? Everything's about having a process. That's how you get good at what you're doing. That's how you get consistent, where you can do the same thing on different days under exactly the same conditions. Then you can get in there and really tweak that thing up, right? So the edge you guys have isn't that you're going to be faster than Goldman Sachs or have more money than Goldman Sachs or have more information than Goldman Sachs. To compete against the big boys, right? You're not gonna outdo those guys. But what you can do from home on a price chart is determine exactly where they're going to turn prices, right? We'll teach you how to identify where those turning points are, where they're going to create a big imbalance, and then once you know where they're going to change the direction dramatically, then it's just a matter of going, okay, well, what's the other side of that? Where's it going to go to ultimately? So once you have those two things, you don't need to be faster from them. They do all the work for you. You know exactly what you're going to do before they do. So also, are you thinking and executing like Wall Street? So let's do this. We're exactly about halfway through. Let's take about a 5-minute break. Kind of stretch the legs a little bit, clear the head. What I'll do in this next section is I'm going to walk you guys through our process, our core strategy. And we'll start talking about how to identify those zones a little bit more clearly. And we'll look at some examples. So take 5 and get some more coffee, and we'll pick up right where we left off.
Can I ask you a quick question?
Yeah.
So this future contract that you said was $400 for the $200.
Yes.
Is it one contract?
Yes.
Is it like $1?
Yes.
Really?
Yeah. So
the
you trade.
dollar, if it moves 4 points, you make that.
Yeah. Well, yeah. If you bought one contract and it went up 4 points, and then you sold it, it'll cost you $1 to buy it and $1 to sell it.
Oh, $1 to buy, $1 to sell.
Yeah.
Because that's the value of the contract.
No. The value of the contract is about $100,000 or $250,000.
Oh, but that's the leverage. With $1, you can control that much, is what you're saying.
No. The dollar is the commission.
Oh, that's the
So they charge you to buy and sell. So what you're actually buying is a contract based on the price of the S&P 500. So you need $5,000 in your account, and you could actually trade up to 4 of these things intraday. So now, I'm only suggesting you trade one at a time. So you click the button, they take a little bit of money out of your account, they set it aside, the market moves up and down, you sell it, they put that money back in your account, and then they subtract the loss or they add the profit. And then this number starts to get bigger. But they're always going to charge $1 every time you
do that.
sell.
Right.
When you buy and sell stocks, they charge you 10.
Right. What I was just wondering was because, like, I mean, the stock is priced X. So, you know, I was just wondering what is the value
So,
of that?
$50 a point. The price of this thing right now is 24, 28.
Got it.
So 24, 29 times 50.
Got it.
249 equals $121,000. So what they're gonna, so you click the button and you buy it. You're controlling this much of a stock index. And what they're gonna do is they're gonna take $1,200 out of this account called margin. They're gonna set it aside while you have that position on. Then as soon as you sell it, they put that money back, and then they either add your gain to your number here, or they subtract your loss. But you control a lot of something for a little bit of money. That's nice. That's what
But the risk is high too, right?
well, no, because if you're only gonna make 200, you'd only be risking 50.
Okay.
Right? So you're gonna, but your risk on anything is the difference between where you're getting in and where you're gonna get out and take a loss. That's the amount of risk. Right. Well, not the delta, but the difference between where you're getting in and where you're gonna exit. Without a loss. So you're gonna risk 100. The difference between where you're buying and where you're taking money. And I'm gonna get into that. Yes. Remember I was talking about 7 and 8? So all three of those levels can go in at the same time in the morning before the market's open. So you tell the broker, I want to buy it at 40, I want to sell it at 39 if I'm wrong, and it goes up to 43, get me out, and I'll take the money and
So you limit your risk.
yes, always.
Yeah.
Always. And you can send all those orders in at the same time, so they just, you don't have to be fun. Super nice. Makes life easy.
Yeah. So this chart.
Actually, to your point of being decisive, I think that's what most people learn. This way, you decide before you put the money in, rather than trying to decide after your money is in and you're going through the emotions.
Because things are different. So that's why you develop your trade plan when you don't have a position on it. And it comes back to all the discipline. So that's
Many years ago, I bought some for $4. It went up to 64. I sold at $4.
before it went up.
Well, on the way back down.
A lot of people do that.
All those things, but yeah, it's just amazing now. Now obviously after if you don't know where to get out ahead of time, you won't make any money.
See, that's one of the things we do is that 3-day, especially the 3-day program. Regardless of what you decide to trade, the first thing you got to know is where those turning points are, where to buy and sell, and how to manage risk. So that's really what the 3 days is all about, right? That's geared towards identifying where the turning points are on chart, and then how to manage risk. Yeah, question?
Futures and forex, like I'm trading in my field account.
Oh, you are?
So basically, but I'm doing stocks only.
Okay.
I try options, there's no options for that. And I must be a mental trader doing it.
Okay.
But my friend told me she took classes at future before and now. And she told me that with my mentality, that I have to learn that.
Yeah.
I thought, if I'm doing that with my skill, I'm still tax exempt.
Yes.
Because that was.
If you're doing it in a tax-deferred account.
Okay.
Yep.
Okay.
And there's a lot of different ways. The brokers nowadays will let you trade all of this stuff now in some of those tax-deferred accounts. So that's what most of our students do. They self-direct either their 401k or their IRA, but they do it with a broker that will let them trade futures and forex. So then you get a nice.
I used to be just technical analysis, but I also look forward because like on the stocks when you get small float actually then it goes up much faster up and down.
Yeah.
So you make fast money.
Yeah.
But I'm just trying to see what are your ideas.
Yeah. Okay, good. Well, we're going to go
Because
through.
like what's the election and stuff and now with the market being crazy, going up and down throughout the day. Actually, what you were talking in minutes.
Yeah. That's the way to trade the stock market.
Because of what is happening now.
Yeah.
Market totally changed.